welcome to CRUSHTHESTREET.com's weekly market wrap-up. Let's get started in the equity sector, where all the major indexes were down following a tremendous run up to near record level highs, with the S&P 500 closing just below the 1500 mark and the Dow Jones failing to hold the 13,900 level. Of course, all eyes are on Friday's jobs report following indications earlier this week that the economy actually contracted. Many financial analysts are blaming this contraction on one-time only events such as steep defense budget cuts, and that, taken in context, the economy shows potential for future growth. Also on late Thursday, a bill allowing the US government to continue borrowing money for at least the next few months beyond the $16.4 trillion debt limit won congressional approval, setting the stage for President Obama to sign it into law. Once signed, this will give Washington policymakers time to go on that Parisian wine tasting trip they've been putting off until they come back on May 19th to wrangle over yet another last-second deadline. Now, regardless of where you stand on the economy, whether bullish or bearish, there will always be specific companies that move directionally in spite of the greater macroeconomic trends. I believe that one such company is Goodyear Tires, or ticker symbol GT. This stock has been steadily rising since mid-November, and there are some fundamental reasons to believe that it could continue going higher. Even if the economy improves, people will always need tires, and Goodyear typically caters to a more high-end consumer. If things go sour, tire demand across the board should increase as people put off buying a new car and instead concentrate on maintaining their current vehicle. Technically, GT charted a head and shoulders pattern between August and November of last year, and the neckline from this formation has been providing a consistently inclining level of support. Today's close puts GT right on top of that support line, which means that it must hold to prevent another decline. If it doesn't, the short-term risk is the 50-day moving average at 1322, but the longer-term risk is a 200 DMA, or a 13% loss from current valuations. The near-term upside is a move to 1450, a 5.4% gain, but the ultimate target is $18, the high reached last year, for a 31% profit. Obviously, in the short run, the risk is higher for a decline, but those who believe in the fundamentals for this company could make a handsome return. Now let's turn to silver, which has once again been getting rocked by selling pressure, and therefore will approach this in a purely rational, non-emotional point of view. The current technical momentum is negative, and we can say this because of the declining resistance level that we mentioned last week that is capping silver's gains at lower and lower prices. We know that at some point the supply-demand dynamics will swing in favor of the precious metals, and that's why, despite the short-term volatility, we never throw in the towel altogether. The immediate risk, however, is a decline to the 200 DMA, which currently stands at 3065, or a 2.6% loss from the current spot price. The bigger question, though, is whether silver will retest the $27 support line from July of last year. If so, that would be a 14% loss of value, although it's difficult to be that bearish considering our macro level situation. Going forward, realistically, the next price target is $33.50, or a 6.4% gain. Given the negative dynamics of the current technical picture, this price point will be difficult to get to, and anybody that has a profitable position in the paper markets may want to consider exiting out. The real battle line is drawn at $35, which has failed so many times before, so I'm very pessimistic about a potential challenge of this price in the immediate time frame. I believe silver investors will need a strong dose of patience before we see a new nominal record being achieved, and in the meantime, people may want to consider the next few months as an accumulation period. And that will do it for this edition. Thanks for watching, and we'll see you next week.
For more unconventional ideas, please visit CRUSHTHESTREET.com.